Welcome back to the channel. I hope all of you are having a great day. So headline and core CPI came in a little bit hotter than expected. We're going to talk about what that means for the markets, why the markets didn't really react like everyone thought they would, especially not myself. And we're going to talk about a lot more into the macro side to see what's actually going on. Why is this such a slow bleed, and what can we expect from the market? Now, before we get into it, timestamps are down below for you guys' convenience, and also go check out our newsletter, which is a weekly newsletter into a deep dive of data, charts, and analytics based on everything we talk about in these videos on a weekly basis. So I don't want to spend too much time on this page because we already know what the numbers are, and we've already been talking about this for a couple of weeks. But basically, core and headline inflation came in a little bit hotter than expected. The consensus was that headline inflation was going to come in at 8.1. It came in at 8.2, which is 0.1% lower than the last month. But the thing that we really want to focus on is core inflation. Now, the difference between these two is that core inflation doesn't take into account energy and food because they consider those a little bit more volatile. So the Fed likes to look at core inflation because, again, it is a lower number, and that's kind of what they like to push. But we all understand that real inflation is even higher than what this number is given to us. But basically, the big thing here is that the actual number came in much higher than the previous month and what the consensus thought. And so, of course, that has made people very hawkish. As you could see, they are expecting a almost 99% 75 basis point rate hike, which if you look at just a couple of weeks ago, right, 1 week ago, we thought that there was going to be a 20% chance of a 50 basis point rate hike. Well, now that is literally at zero because of the hot inflation. Just a month ago, we were almost at 31% for that number. But now some people are even thinking that there's a 1% chance that we get a 100 basis point rate hike, which means that people are believing that the Fed is going to be very, very hawkish, more hawkish than we thought just about a week ago. So let's hop into the charts. Let's talk about it a little bit and see what's going to happen from here. So this is headline inflation. Obviously, we know it's at 8.2%. As you can see, it is downtrending a little bit. Typically, when it starts to downtrend, it's a little bit of a better sign. The problem with this is that it is not downtrending fast enough. I mean, over the past couple of weeks, months, we hit 9.1%, and then it kind of went to 8.7, 8.5, 8.3, 8.2. So as they're raising interest rates at record pace, inflation is kind of just lollygagging, and it's really not moving that far down. And the problem that the Fed is facing right now is that core inflation continues to go up, and this is their main concern. Obviously, it is a little less volatile because they don't add food and energy into this number. But as you could see, it did just break above this high. Maybe it did last month too as well. But one of the things is that this is not slowing down. Even though headline inflation may be slowing down, their main concern, again, is core inflation. And that continues to come in hotter and hotter every single month. And so that's going to force the Fed to continue to be very, very hawkish. So if we actually head over to the interest rates and take a look at what this is telling us, I have this little yellow line marked out at November 2nd at 4%. This is most likely where the Fed is going to raise interest rates, right? 75 basis points from where we are now, basically just 0.75% in terms of interest rates. The target rate is probably going to be a little bit higher. And, as we map out the future, people think that the rate that we're going to end up at, the terminal rate, is going to be right here around 4.75%, basically anywhere between 5 and 4%. And by next month, we should be in that range. But if core inflation and normal inflation continue to stay high, we can see ourselves pushing a little bit higher, maybe even to 5.25, 5.5. We don't really know. But what we do know is that if inflation does not come down, they're going to continue to stay hawkish and continue to push interest rates down. Now, whenever we actually reach our peak, once we get to this point when, let's say the Fed pivots or whenever they stop raising interest rates, that's going to be when inflation comes down because, again, that's their main concern. One problem with this is that if we overlay the unemployment rate, you can see that the interest rates are blue and the unemployment rate is orange. So one of the concerns that we are having here, let me move this over a little bit. So whenever interest rates are being raised, typically unemployment is going down at the same time. Not really the correlation I'm trying to point out here, but as you can see, in history, as the unemployment rates are going up, inflation is going, or unemployment is going down, interest rates up. So basically this happens over and over and over again in history, but typically once we finally reach the peak, once we stop raising those interest rates, that's also when we bottom out at these unemployment rates, right? We see it over and over and over again. But the next thing is what's important. After we start to pivot, this basically takes an effect on unemployment, right? As you can see, once we start to slow the process of interest rates, or once we stop, the next thing that happens is that unemployment skyrockets every single time. I mean, you could see like as interest rates go down, unemployment up, right? They're inverse. So they are doing the opposite of what happens. So let's say we do get to this point, right? We get to 5%, between 4%, right around here. Interest rates kind of go up, they stagnate, and then they start to go down. Well, you can imagine that unemployment would do the opposite and skyrocket. Whenever unemployment skyrockets, whenever we start to very rapidly increase in unemployment, and once we get to around this peak, this is also a very good correlation of when the S&P 500 and risk assets also bottom out in the markets. So unemployment is also another very reliable and trustworthy indicator showing us that whenever unemployment starts to rise, and whenever we get to the peak or very close to the peak, which again, we don't know what that number will be, it is also a good indication that that might be the bottom, right? And right now, unemployment is very low, at historical levels of being low. So until the interest rates actually bottom out, or until they stop raising interest rates like they do over here, that's probably when we'll actually see the bottom of unemployment. But the next thing to come is that whenever they start to lower those interest rates or actually pivot, that's when unemployment skyrockets every single time. And again, that's when we can see the US dollar start to fall, and also the risk assets bottom finally being set in. But until then, until they keep raising interest rates, the main thing that we're looking at is that the DXY is going to continue to go up. Again, because as interest rates go up, the dollar becomes a little bit stronger because of those rates. And as the DXY goes up, Bitcoin does not do so well against it, really just any risk assets. And let's overlay that chart. And so what you could see here is the candlesticks are the DXY, and the orange line is Bitcoin. And obviously over, as you could see in history, anytime that the DXY starts to get stronger, risk assets and Bitcoin gets weaker. That again, this is also an inverse pair. And as we're looking at it, if interest rates continue to go up and the Fed is more hawkish, that is good for the dollar, that is good for the DXY. And we have a target rate of 120 to 119 points, because those are early 2000 historical levels in the markets, which if we go all the way back, you can see that this orange line originates from right around this time, around the dot-com bubble. So if we go back to the charts, if the interest rates continue to get risen, that's going to make the DXY a little bit stronger. If the DXY goes up, that means Bitcoin should go down. The problem with this is that you can see that there's a very strong floor for Bitcoin right now, where it's just not breaking 19,000. But if the DXY does continue to push up higher and higher and higher and make those new highs, anything breaking these, then we're going to see those effects take place in risk assets, meaning we will most likely see Bitcoin break that floor, which again has been a very strong floor ever since right around middle of June. So I know I've been spewing a lot of charts at you guys a little bit quickly, but basically to recap, inflation continues to go up. That continues to make the Fed hawkish. If the Fed is hawkish, they raise interest rates. As they keep raising interest rates, that makes the dollar stronger. As the dollar gets stronger, risk assets get weaker. So with all of that in mind, let's look at what we talked about yesterday. So obviously I was wrong, and I'm glad to admit it, because we really don't know what's going to happen in the markets, right? We try to predict, we try to take a look at the charts and help us understand what's going on. But basically, this is another reason as to why I don't day trade anymore, and I don't think anybody else should. As you see in the markets, I mean, no matter if you were bearish or bullish, both were right, but it really depends on the timing of it, right? So what happened was that CPI came out and immediately it was hotter than expected. And what happened in the markets for a brief moment is that the markets actually did go down, right? Almost 3%. So the markets did go down, let's see. So CPI came out, markets dropped around 4%. So bears were right. And then immediately after, the market rallies to the upside. From this low, all the way from down here, the markets have rallied almost 10%. So whether you're a bull or a bear, depending on the timing, you were either right or you're wrong. Probably mostly wrong. But the interesting thing here to note is that look how far down this wick went. Look how far down price went. It's basically in perfect correlation with these lows right around here. And again, it's invisible, but as you get closer to these lows and volatile news events, margin starts to, the bid and ask spread gets a little bit larger. And so typically what happens is people will easily get margin called out of the markets. So right around here. So even though the wick didn't go lower than right around here, the invisible bid and ask spread may have margin called some people. So, and then what happens is we are again back in this consolidation zone, basically just waiting in limbo. But the important thing to remember is if we look at the macro, as the DXY gets stronger, it is a very, very strong inverse correlation with Bitcoin. Again, as the dollar gets stronger, it's going to make Bitcoin weaker. And with interest rates and the Fed being hawkish, I mean, this is just a long-term play that Bitcoin is going to get down to these lows, maybe 17,500. But I believe it's going to fall into this accumulation zone because it's not going to be possible for Bitcoin to rally in this type of an environment. It's just the liquidity is not there, the sentiment is not there, and we're just not in the right place and not in the right time. So again, just kind of prefacing, that's exactly why short-term trading is very dangerous, because nobody is usually right on what's going to happen and it never really plays out for you. But in the long term, it's a little bit easier to understand what's going on because macroeconomics move a lot slower. The data comes out a lot slower, so you can think ahead and understand what might happen. And again, since inflation came out hot, Fed is going to stay hawkish, and until they continue to raise interest rates, until they pivot, that's when we could actually see the markets pivot as well. But if they keep raising them, then that's just going to keep selling off and lowering these prices of risk assets. And for me, I'm just going to be waiting, stacking cash on the side and waiting for these better prices, right? Because I understand that this is a very strong floor. And as the floor gets stronger, that means there's going to be more of a volatile breakout like we had in 2018. But that is everything I have for this video. I hope you guys enjoyed it. Took a little deep dive into a little bit of the macroeconomics. If you guys found value in it, make sure to like and subscribe to the video down below. And again, leave us in the comments what you liked, what you didn't like. And then we'll see you guys next time. Peace.